Hello everyone and welcome to another real estate video. This is Javier Vidana, the real estate YouTuber in Phoenix, Arizona, here helping you accomplish your home goals. I recently got this question from one of my subscribers and I think it was a really great question because right now, especially first-time home buyers, there's a really weird shift happening. I've explained to it in many videos already how their first-time home assistant programs are kind of, they're still out there, but they're not really as beneficial anymore. So people are actually having to save up their down payment now, and now the question comes up saying, should I go with FHA or should I go with conventional? Both of them, they kind of sound the same, and when you talk to a lender, they kind of have similar numbers, but no one really takes the time to explain what are the actual differences between each of them. So in today's video, I plan to give you a quick synopsis of each loan, what the pros and cons of each one are, and hopefully it helps you narrow down which decision to make, FHA or conventional. Let's get to it. Let's start off with FHA. FHA has been really popular for the last, as long as I've been licensed, which is about almost 6 years. And the reason is because their interest rates have been ridiculously low. I mean, I remember when I first got my license, there was as low as 3%, 3%-ish, and maybe up to maybe a year ago, they were about 3.5% to 4%. So they were pretty low. And not only that, but even they released a down payment assistance program, Home in 5, where basically folks were able to get this low interest rate, and maybe just a little higher, but get a low interest rate, have the government pay almost the entirety of their down payment, if not all of it, and get to buy a home. Really, it would really cost them almost nothing to buy a home as long as they have the qualifying factors. As of this year, that all changed, and if you haven't watched my video, I talk all about the big changes that happened in 2018 and how they're affecting this market. In brass tacks, FHA, just like VA or USDA, is a government-backed mortgage loan. It's pretty simple. It's kind of like a one credit score fits all kind of situation. I think the minimum credit score is a 600, if not 580 in special situations. But as long as you qualify for that credit score, you got the whole package, baby. Interest rate is whatever the government dictates it to be. Right now, it's about 4 to 5%, and yes, I'm leaving it vague on purpose because I don't want to get in trouble. The interest rates have been historically a lot lower than conventional loans. So technically, unless something changes, it is a little better interest rate wise to go FHA. The down payment is pretty simple, 3.5% down. Of course, there are other down payment assistance programs, which in that situation, another government entity, if not the same one, gives you maybe 3% of your 3.5%. But please know, in that situation, everything really changes because the interest rate's a lot higher. But let's just stick to the basic one for now. It's 3.5% down. You could put more down payment if you want, but I mean, basically, if you put more down payment, it's going more towards. It's not to benefit the actual loan. It's just really going to make your loan amounts less. I don't know if a lender is able to actually buy points down on the interest with the extra money. I think they might be able to do that, but really putting more down payment for an FHA is not really that as helpful as it is with other loans. I've explained to you in another video where I break down a monthly payment for a mortgage. And part of that mortgage, surprising to a lot of people, is a mortgage insurance. Mortgage insurance is basically an entity insuring the lender against you. Meaning if you decide to default on your lender, this insurance is going to kick in and basically give the money to the lender, and then that goes to the government. So with FHA, usually it's a lot higher than a conventional PMI. And not only that, but it sticks with the life of the loan. So it doesn't matter if you have it 50% off, 20% paid off, 80% paid off. If you're about to pay it off the next month after 29 years of hard work, it doesn't matter. You're paying that same mortgage insurance for the entire life of the loan. The only way that's going to change is if you refinance it or you pay it off, but you're paying that mortgage insurance. So it's almost like you could put more money towards it. Like you can make extra payments towards your house while you're living in it. It's not really as beneficial to keep paying it off fast as you can. Sure, I mean, down the road, I guess it'll save you a few years of paying a mortgage, but for conventional, there's a huge advantage to it, which I'll talk about right now. But that's the thing about FHA. You get what you get. You're going to stick with it, and that's the same thing you're going to have for the rest of your life. So in conclusion, that's the benefit of FHA. If your credit score isn't that great, you don't have much of a down payment, it's a great option for a first-time home buyer. Because like I said, you could have a 601 credit score. As long as you have the 3.5% down, you'll be able to qualify. You're not going to get less or harsher things because you're close to that 600 mark. So for folks that maybe didn't make the right life decisions or had some mistakes earlier in their life and now their credit isn't as great as they wanted it to be, well, it doesn't have to be that bad. Of course, I will give a caveat for down payment assistance programs. They do require you to be closer to 660, but if you have a 3.5% down payment, you can definitely do standard FHA. Now let's go to conventional. Conventional is basically a mortgage loan that is conforming. Conforming meaning it's under the guidelines of Fannie Mae and Freddie Mac, I believe the entities are called, which are government corporations, but the loans are conforming to their guidelines. So they're technically about the same guidelines of FHA. There's some very slight differences, but it's still very much a very secure mortgage. So because conventional is not backed by the government, there's a lot more at play here. This is not definitely a one credit score fits all situation. If you, let's just say the minimum credit score for a conventional might be 620, well, if you're at 620 and another buyer next door to you is at a 750, that buyer at 750 is going to get a lot better terms than you. They're going to get offered a better interest rate, they're going to get offered less mortgage insurance, and overall they're just going to get a better package, and they have a lot more negotiating power, meaning they can go to several lenders and they can even compete for their business because they know that is a very solid buyer. If you're barely meeting the threshold at 621 or 620, then odds are you're going to get a thing and you can shop it around, but you're not going to get the best interest rate, you're not going to get the best mortgage insurance, and really there's not much you can do about that unless you stop and get your credit score higher. So if you've been very meticulous about your credit score, you took care of it really well, and it's something you have great pride in, this is a great option for you. You really see the kind of the reward in it, right? Whereas FHA, it doesn't matter. With conventional, you can actually get a benefit and reward from you taking care of your credit. But with conventional, you will have a higher down payment. The minimum down payment for a conventional product is about 3%. Then from there goes to 5%, 10%, it doesn't matter at that point. You do need a down payment. There are very few down payment assistance programs for conventional. And regarding the interest rates actually have been historically higher than the FHA interest rates. Now I know the situation is they're not that different now because maybe their conventional is still a little higher, but back in the day, I mean, it was at least a 1 to 2 to 3 points higher than FHA. So even now, I mean, it's still maybe I'd say 1 to 2 points higher in some situations, depending on your credit score, obviously. But if you're like barely at a 620 and you're looking at a conventional and FHA product, even though conventional you're putting 3% down and then FHA 3.5%, it might make more sense to go FHA because your monthly payment will be less because the interest rate's a lot lesser. It's a little bit less than the conventional one. A lot of people don't think a half point or a 1 point of interest really affects you, but you know, at the end of the day, it might be a difference of 50 to 100 bucks depending on your price range. And now comes the huge advantage of a conventional product. Remember, we talked about the mortgage insurance with FHA. Whatever you get when you first get your home, that mortgage insurance is what you're going to pay for the rest of your life or the 30 years, unless you decide to refinance it or sell it and get another home. Conventional, it's a little different. So as soon as you reach about 80 to 20 loan of value of your home, that mortgage insurance gets booted out and is no longer on your monthly payment. Let me explain. Let me just use the number 100,000. Obviously, it's a crazy number. I wish we can buy homes at that price now, but let's just use it because it's a very easy number to understand. Let's say you buy a house for 100,000, you put 3% down, so your total loan when you buy the home is about $97,000. So as you live in the home, you're going to be making payments, right? So maybe after 1 or 2 years, you're at 90, 95, 94. Maybe after 5, let's just say about 8 years later, you owe about $80,000 on the home, and your original value of that home was $100,000. So that means that your loan is $80,000, the value of the home is $100,000, so you would be at 80 to 20 loan of value. But wait, that really doesn't make sense, right? If you did catch it, well, here's the thing. When you're living in a home, you are paying your mortgage down and your loan goes down, but guess what? If the market's great, which is how it's been recently, your value is also going to go up. So there's like 2 factors working towards you. And remember how I said with FHA, it doesn't really make sense to pay more towards the principal unless you just want to pay it off sooner. With here, it makes sense. If you want to put more towards the principal, it helps you kind of widen the gap a little more. So as your home gets more value, because the market's going up, your home is getting paid, and maybe if you make extra payments, it goes even lower. So I've seen people meet that 80 to 20 loan of value about 3 to 5 years. The mortgage insurance, which could be $100, $200, $300, $400 on your monthly payment, gets knocked out. So now you're purely paying your mortgage, your interest, your taxes, and your insurance. That's it. You're not paying anything other additional. And I love that. I'm all about seeing progress, right? So like if you want to make the extra effort to make extra payments, it's going to help you, because if you can reach that 80-20 loan to value a lot quicker than most people, then you're going to be able to knock and save yourself those extra few $100 a month. Whereas with FHA, you're not going to ever be able to take that off. So to kind of piggyback that, that's why sometimes it still might make sense to kind of get the higher payment up front and kind of just, you know, bite your tongue and get it done, because you know down the road that loan to value is going to meet 80-20 soon. And now, even though the higher payment was a lot higher originally, it's going to be a lot less with conventional. And of course, not just bashing FHA. FHA is still not a bad product, but my recommendation is if it's a first home that you know you're only going to live for a few years, maybe 3 to 5 years, and that's the best option you can because your credit isn't that great, well then get that home. It's better than renting. Don't throw your money paying rent. Get the home and live in there comfortably, maybe fix it up a little, and then when it's time to buy the next home, you're going to sell that home, get the equity from it to pay your down payment for the next home, and make sure your credit is as high as possible. And thank you guys for watching. I know today was a little longer video, but I wanted to make sure that it was very thorough and covered everything. I'm not a mortgage lender, so if you have any additional questions about these actual things I'm talking about, please contact your lender. They'll be able to explain a lot better than I did. And if you happen to be in the Phoenix, Arizona market and you're looking for a home, please, my information is below, or you can contact me on my website. And if you're out of Arizona and you're still looking for a realtor, I can help you find one. It will take me a few days, up to a week, to find one, but if you fill your information below and there's a link in the description, you can fill your info in and I can try to find you a great realtor. Thank you guys for watching. Hope you have a great day.